Your next reading is Understanding Income Statements. Question number 1. At the start of the year, our company acquired a new equipment at a cost of 50,000 euros, estimated to have a 3-year life and a residual value of 5,000 euros. If the company depreciates the asset using the double declining balance method, the depreciation expense that the company will report for the third year is closest to. Now, since the asset will last for 3 years, we have to calculate the depreciation for the third year. We first will have to determine the depreciation percentage. Double declining balance method means that first you need to calculate the straight line depreciation rate. If an asset is assumed to last 3 years, which means 1/3 of the asset's life is covered in 1 year, which means it's 33.33%. So this is the straight line percentage. Double declining balance means that whatever the straight line percentage comes, you double that. You multiply that with 2. So it means the depreciation rate you will use is 66.67%. I'm going to spend some time on this question so that you will get some better understanding how to calculate depreciation for each of the 3 years and how do we calculate the book value at the end of each of these given 3 years. So let's just do a detailed scheduled working. It will take time, but just I need to make sure that you understand the concept. Depreciation in year 1, 2, 3 and book value at the end of year 1, 2 and 3. Since the original cost is 50,000 euros, the first year depreciation would be 50,000 multiplied by 66.67%. It will give you 33,333. If this is the first year depreciation, then what will be the book value at the end of the first year? Of course, original cost less the depreciation charge in the first year is going to be 16,667. Right? Now we can just proceed with the next year. We can calculate next year depreciation by just taking this first year depreciation as our base and multiplying this value with the remaining percentage. 66.6% out of 100 gives you 33.33%. Multiply this with 33,333. It will give you the depreciation for the second year. Now, what normally you would do for the third year, let's say since this asset has an estimated life of 3 years, let's say if it has a estimated life of 5 years. So in the third year, what you would do, you will take 33.33% of this number. But one important point to note, that your book value at the end of year 3, it is 16,667 less 11,110 or 111 if I put the complete number. It's going to be 5,555. Right? Now, if you charge depreciation at the rate of 33.33% on this number, or this is the depreciation rate, then the depreciation charge would be higher. We need 5,000 euros. No, I did not use 33.33% in the first year. Now, if I take the same route and I multiply 11,111 with the 33.3, this will give me 3,700. I can't charge this depreciation. I need to have 5,000 euros as my book value at the end of year 3, which means then the third year depreciation will be the difference between the book value at the end of year 2 and the book value that we want at the end of year 3. That is the residual value. So it means the depreciation to be charged will have to be a balancing figure, and this is 555, and that makes B to be your correct option. Right? We will do a couple of questions that will further make things easier for you. An equity analyst is forecasting next year's net profit margin of a heavy equipment manufacturing firm by using the average net profit margin over the past 3 years. Okay, so you are basing your future forecast over the last 3 years' profit margins. In making his profit projections, he identifies the following 3 items. First, the company reported losses from discontinued operations in each of the past 3 years. Okay. Second item, the most recent year's tax rate was only half of the prior 2 years' rate as a result of a fiscal stimulus. Maybe the economy was in downturn, so government reduced the tax rate so as to stimulate the economy. So let's say the regular rate is 40% over the last 2 years, but in the previous year the rate was reduced to 20% as a result of fiscal stimulus. Okay. Third, the company reported gains on the sale of investments in each of the past 3 years. Gain on sale of investments in each of the past 3 years. Remember, it's a heavy equipment manufacturing firm. It's a non-financial service firm. Okay, keep that in mind. Which of the following statements about the preparation of the forecast is most accurate? Let's discuss these one by one. The analyst would use the most recent tax rate because it is the best predictor of the future tax rate. Well, this 20% is maybe just for a few years, maybe just 1 or 2 years or a couple of years more. It's not going to sustain in the long run. This rate, the half of the regular rate, it's just a temporary fiscal stimulus and it should not be used for longer run projections. So this is not right option. B, exclude the gains on the sale from investments because the firm is a manufacturing firm. That was the reason I highlighted. Heavy equipment manufacturing firm. This is true. True. Gain on sale of investment, this is not the core area of the business. This is not a continuing activity. Then option C, include the losses from discontinued operations because they appear to be ongoing feature of the company. This is not, again, true. Gains or losses on discontinued operations, they are not a frequent occurrence, so they should not be included. So it means the only option that makes sense is B, and that is your right option. Moving on. The following information is available on a company for the current year. We have net income, average number of common shares outstanding. Details of convertible securities outstanding are given as follows. Convertible preferred shares outstanding, 2,000. Dividend per share paid is $10. Each preferred share is convertible into 5 shares of common stock. Okay, that's an important information. Convertible bonds, $100 face value per bond, 8% coupon. Each bond is convertible into 25 shares of common stock. Corporation tax rate is 40%. What are we required to do? The company's diluted earning per share is closest to. Now, this is how we calculate diluted earning per share. We take our conventional EPS formula, net income minus preferred dividend upon weighted average number of shares. Since we have to calculate, this is what you see in the numerator and denominator, this is what we use to calculate our basic earning per share. Since we have to calculate the diluted earning per share, so we will have to make some adjustment in the numerator as well as denominator. In the denominator, you will add shares from conversion of convertible preferred stock. These. Since when these preferred stocks are converted, we will no longer be required to pay the preferred stock dividend, so we will have to add it back. Convertible preferred stock dividend needs to be added, which means this will be cancelled out with these two same numbers, 1 in plus, 1 in minus. Right? Then shares from conversion of convertible debt. If debt is converted into common stock, we will be saving upon our interest expense. And since interest is a pre-tax item, Whereas net income is after tax, preferred stock dividend is an after tax item. So we will have to make an adjustment for interest and give it in after tax basis. So convertible debt interest into 1 minus tax rate. Now these are the adjustments in the numerator and denominator to your basic earning per share, and this will give you the diluted earning per share. So let us plug in the numbers. Net income 1 million. Preferred stock dividend has been cancelled out, plus minus, right? Convertible debt interest. We have 80,000 convertible bonds. Coupon is 8%, which means interest is 8% of 80,000, that is 6,400. Since it's pre-tax, we have to multiply it with 1 minus tax rate, that is 40%. In the denominator, we have been given the average number of common shares outstanding. That will appear right here. Shares from conversion of preferred stock, that's the conversion. There are 2,000 preferred stock. Each preferred stock will give you 5 shares, which means there will be 10,000 new common stocks if these preferred stocks are converted. All right, then what about bonds? Each bond is converted to 25 shares. How many bonds do we have? $80,000. Each bond has a face value of 100. And this will give you the number of bonds, and each bond will convert into 25 common stocks. So if you simplify all of this, it's going to be 800 times 25. It's going to be 20,000. 20,000. So it means this is going to be in the denominator. So now what's going to be your final numerator number? 1 million plus 6,400 times 1 minus 40% upon 100,000 plus 10,000 plus 20,000. If you simplify all of these, your result would be 7.72%. 7.72. That's your diluted earning per share, and it perfectly matches with your option A. Next. Apex Consignment sells items over the internet for individuals on a consignment basis. First of all, when you send some goods to your agent who will sell goods on your behalf, goods on consignment is your property. The consignee who receives your goods, he will get a certain amount of commission. Right? That's an important piece of information. Apex receives the items from the owner, the principal, lists them for sale on the internet, and receives a 25% commission for any item sold. Apex collects the full amount from the buyer and pays the net amount after deducting his 25% commission to the owner. Unsold items are returned to the owner because it's the owner's property after 90 days. During 2009, Apex had the following information, and what exactly are we looking for? How much revenue should Apex, the consignee, should report on its 2009 income statement? We need to see how many goods he sold or what's the value of sales he made. Total sales price of the items sold during 2009 on consignment was 2 million euros. Total commission retained by Apex during 2009 for these items was 500,000 euros. Let's verify this number. If this is the sales value, 25% is the commission. So 25% of 2 million is 500,000 euros. So he was right in deducting this amount as his commission, and this is what he will report as his revenue. So that makes A to be the correct option. Next. Unrealized gains and losses on securities categorized as available for sale. Okay, now this is one of the classification of investments. Available for sale debt securities. Any fair value, unrealized fair value gain and loss. It is reported as a part of other comprehensive income. Other comprehensive income specifically contains 4 items. We'll discuss later in a separate question. Here we just need to know that available for sale debt securities, any unrealized gain and loss on available for sale securities goes to other comprehensive income. Unrealized gain is added to OCI, unrealized loss is deducted from OCI, and it's for available for sale debt securities. So the question is, unrealized gains and losses on securities categorized as available for sale do not affect shareholders' equity. Any gain and loss, whether realized or unrealized, eventually it will hit equity. So it will. Do not affect equity, wrong. It does. Affect the profit and loss statement as unrealized holding gain or loss? No. Available for sale debt securities, fair value gain or loss, unrealized gain and loss, it is not reported as a part of your income statement. It is reported separately in other comprehensive income. Let me tell you, there are principally 4 different types of items we report in other comprehensive income. I'm sure you would have gone through your reading. Other comprehensive income includes unrealized gain and loss on available for sale securities, foreign currency translation on subsidiary. If you have a foreign subsidiary and you translate foreign subsidiary financial statements into your reporting currency, any gain or loss on the translation is not your income, rather it is reported as a part of other comprehensive income. Third, unrealized gain and loss on any effective portion of cash flow hedge. And finally, defined pension benefit plan, any unrealized gain and loss on such a defined plan is also reported in other comprehensive income. Now, so it means A is incorrect, B is incorrect. Then what about C? Unrealized gains and losses on security categorized as available for sale affect shareholders' equity through other comprehensive income? True, right here. So that makes C to be the correct option. Next. During 2009, Accent Toy PLC, which began business in October of that year, purchased 10,000 units of a toy at a cost of £10 per unit in October. The toy sold well in October. In anticipation of heavy December sales, Accent purchased 5,000 additional units in November at a cost of 11. This is the original cost you purchased your 10,000 units. Price went up in November and now it's at £11 each. During 2009, Accent sold 12,000 units at a price of £15 per unit under first in first out method. What is the Accent cost of goods sold? Cost of goods sold. First in first out method means the earlier cost will be charged to your production or cost of sales, and the latest costs will go to your closing stock. So since you sold 12,000 units, and out of these 12,000, older goods are sold out first, older costs are charged to production first, which means out of these 12,000 units, 10,000 units are priced at 10 each, the cost, the older cost, and the remaining 2,000 units, they were from your latest purchase, 11. So that would be 10,000 times 10, 100,000, and 2,000 times 11, 22,000. So if you add these two up, you will get 122,000. Had it been last in first out, you would have done totally opposite. It would have been, let's say, we got our answer, it's B, but had it been LIFO, then it would have been 12,000. The latest purchase, 5,000 units at the rate of 11, and the balance, 7,000 would go from your earlier purchases at 10. But that's not the case. We need to do it using FIFO, so that makes B to be the correct option. Next, at the beginning of 2009, Glass Manufacturing purchased a new machine for its assembly line at a cost of $600,000. This is the original acquisition cost. The machine has an estimated useful life of 10 years, an estimated residual value of $50,000. How much depreciation would Glass take in 2009 for financial reporting purposes under the double declining balance method? Now, again, we'll do the same thing. 1 upon the estimated life, which is 10, times 100 gives you a percentage, straight line percentage of 10. Under double declining method, what you do, you double the percentage to 20 and use this as our basis to calculate your declining balance depreciation. I'm going to go a step ahead, not just to calculate the depreciation for the first year. I will show you how it actually works and saves your time if you follow a smart approach. 2009, we just need to calculate for 2009, but let's calculate for a couple of years into the future. Let us calculate depreciation and book value separately just to have an idea how it works. First year depreciation, we have the rate 20% of $600,000. So the depreciation for the first year is going to be 120. Now what will be the depreciation for the next year? 100 less 20, 80%. You simply take 80% of this number. This will give you the depreciation for the second year straight away, $96,000. What would be the depreciation in the third year? You take the same percentage, 80%, multiplied by $96,000 and it'll give you $76,800. Now, how do we calculate book value in each year? You take 20% depreciation the first year, the remaining 80% represents your book value. 80% of $600,000 gives you the book value at the end of the first year, that's $480,000. What about second year? Second year book value will be 80% of $480,000 and that will give you $384,000, and we'll do the same for the third year. There's a shortcut as well, a further shortcut that will help you to calculate book value straight away, $307,200. You can calculate book value by just simply multiplying your original historical cost with 1 minus double declining percentage raised to the power whichever year you're talking about. If it's the third year, put N3, 1 minus the percentage, multiply this with 600,000 and you will get your book value at the end of that particular year. So right now we just needed the first year depreciation, that's C. Next, which combination of depreciation methods and useful lives is most conservative in the year of depreciable asset is acquired? Being more conservative means charging highest possible depreciation and taking as little estimate of the estimated life. The estimated life should be as short as possible. Depreciation should be highest and the estimated life should be as short as possible. This will result in higher charges of depreciation expense in the early years. So in order to achieve this, to be more conservative, we need to find the depreciation method that results in the highest depreciation, and of course it's going to be declining balance depreciation. In this method, the depreciation percentage is highest in the early years, just like see, 120 fell to 96, so the depreciation charge is highest in the early period. So we will go for declining balance depreciation method, and we need shorter life so as to get rid of the asset and being more conservative in our estimates. So it's going to be declining balance depreciation method with short useful life. This combination will provide you the most conservative estimate of your profitability. That gives you C to be the correct option. Next, under IFRS, a loss from the destruction of property in fire would most likely be classified as what? First of all, extraordinary items are not permitted under the US GAAP as well as IFRS. Let us be very clear. Extraordinary items were allowed earlier under the GAAP and they were never allowed under the IFRS. But of course now they are not allowed in any of the financial reporting regimes. So where would we classify them? Loss from the destruction of property in a fire. It is not a discontinued operation. Discontinued operation relate to disposal of an operating division or a segment of the firm. So this is not a discontinued operation. Other comprehensive income, as I just told you, there are 4 specific types of transactions we report in OCI: available for sale, debt securities, unrealized gain and loss, pension issues, foreign currency translation, and gain and loss on effective portion of a cash flow hedge. So none of the transaction is given here. So it means it cannot be in the other comprehensive income, that it has to be in the continuing operations. So yes, a fire is not a regular occurrence, it's quite an infrequent occurrence, but it would still need to be reported in continuing operations, right? So that makes A to be the correct option. Next, for 2009, Flamingo Products had net income of 1 million. At 1st January 2009, there were 1 million shares outstanding. On 1st July 2009, the company issued 100,000 new shares for 20 per share. The company paid 200,000 in dividends to common shareholders. What is Flamingo's basic earnings per share for 2009? So basic earning per share is what you call the income available to common stockholders or income attributable to the common stockholders. That is net profit minus preferred stock dividend. IACS, I call this ICS for many years, IACS, income available to common stockholders, divided by the weighted average number of shares. That's how you calculate your basic earning per share. So do we have net income? Yes, we do. Is there any preferred stock dividend? It's only common stock dividend. So that is not deducted from your IACS, just preferred stock dividend. So that means we are going to take what is given to us as our net income, no deduction of preferred stock dividend, and we need the denominator, the weighted average number of shares. How many shares do we have at the start? 1 million shares. And they remain outstanding throughout all these 12 months, so they will carry a weight of 12 out of 12. Then we issued additional 100,000 new shares on 1st July, and which means they remain outstanding July, August, September, October, November, December, 6 months. So it means these 100,000 shares will carry a weight of 6 out of 12, means 50,000. 50,000 plus 1 million, it means the total shares, weighted average number of shares is 1,050,000. Actually, there are 1.2 million shares. 1 million were already in issue. 200,000 were issued partway through the year. Actual share is in existence are 1.2 million. But for the purpose of calculations of basic earning per share, we need the weighted average number of shares that considers the time lag between the stocks transactions. So 1 million upon 1.05 million, if calculated, should give you $0.95 per share. That makes C to be your correct option, and C it is. Next, for its fiscal year end, Calvin Water Corporation CWC reported net income of 12 million and a weighted average of 2 million common stock outstanding. The company paid $800,000 in preferred stock dividend and had 100,000 options outstanding with an average exercise price of $20. CWC's market price over the year averaged 25. CWC's diluted earning per share is to be calculated. So what we do, that's what we do. This is the formula that you need to know. Okay. Net income, 12 million. Preferred stock dividend. There is no information for preferred stock dividend. Do we have it? Let's just look. The company paid 800,000 in preferred. Yes, we have 800,000 in preferred stock dividend, which means needs to be deducted. But then we see convertible preferred dividends being added. We need to ignore this. Why? Because there is no indication given that the preferred stock is convertible. So this part of the numerator and denominator is rejected. And we still do not have any information regarding the convertibility of bonds, because the debentures, no information is given, so it means this needs to be ignored now. This is one important thing that needs to be considered. We have share options. Shares issuable from stock options. This is the adjustment we need to make in the denominator. This part is already there. We have them here. These are the shares given, 2 million. So we're going to write 2 million in the denominator. What about shares issuable from stock options? There's a formula which you can use to calculate the shares issuable from stock options by just plugging in the numbers. AMP minus EP upon AMP times the number of share options. AMP is basically the average market price, which in our question is given as 25. Exercise price is 20. Average market price is 25, and multiply this with the number of options outstanding. Each options, each share. So if you simplify this, 25 minus 20, that is 5. 5 by 25 times 100,000. It means it will add to 20,000 additional stock. Okay, that's the shortcut. But what is the logic behind this? What 20 represents? Let's first calculate our result also. So it's going to be 12 million less 0.8 divided by 2.02 million. It gives you 5.54. So we got our answer, but we need to just make sense of this 20,000 addition to the denominator. Let us just try to make sense out of it. These 100,000 share options, when exercised, will bring in how much cash for the firm? 20 times 100,000. Of course, it will bring in $2 million cash. Now, if this $2 million cash is used by the firm to acquire shares from the market at this price, how many shares can a firm purchase? 2 million upon 25. It means the firm can purchase 80,000 shares, and in return the firm will have to issue 100,000 shares. So this is what the firm will issue, and this is firm can repurchase from the market as a treasury stock. So the net increase in shares is 100,000 less 80 gives you 20,000, the denominator that we calculated using that shortcut. Nonetheless, we got our result. Whichever method you use, it's 5.54. That makes B to be your correct option. Next. A company with no debt or convertible securities issued publicly traded common stock 3 times during the current fiscal year. So there is no convertible debt or any convertible security, means preferred stock. So under both IFRS and US GAAP, the company, first of all, when the company has no debt or convertible security, it means the company has simple capital structure. Simple capital structure. In this situation, when the firm has simple capital structure, the basic earning per share is equal to diluted earning per share, because there is no any instrument that is dilutive in potential. So EPS equals diluted earning per share. This is the correct option. Look no further, but let's see, let us convince ourselves we got the right option. Capital structure is considered complex. No, it is not. And it will not be considered complex at the end of the year, because there is no such instrument that is dilutive, any debt or convertible security. Basic EPS is calculated by using a simple average number of shares outstanding. Not simple. It's weighted average, weighted based upon the time between the stock transactions. So that makes A to be the correct option. A it is. Next. Laurel Builders reported the following financial data for the year ended 31st December. Common shares outstanding. Common shares issued as stock dividend on 1st June, 5 months after the first transaction. Then warrants outstanding 500,000, net income 3.35 million, preferred stock dividend paid 430,000, and common stock dividend paid 240. All right. Which statement about the calculation of LB's EPS is most accurate? Let us first calculate EPS. EPS is income attributable to the common stockholders divided by the weighted average number of shares. So your net income is 3.35, out of which we need to deduct your preferred stock dividend. So it's going to be 3.35 million minus 430 divided by the weighted average number of shares. So this is the number of shares at the start of the period, and common shares issued as stock dividend on 1st of June. So most of you would probably give it a weight of 7 months out of 12, but that would be wrong. Stock splits, stock dividends are assumed to be outstanding from the earliest reported period. We don't time weight them. We simply add them up in the given number of shares. So simply need to add them. Even they were issued just maybe a month before the year end, you will have to give it the full weight as if they were outstanding or they were issued from the earliest reported period. So you just need to add these two up. No weightage is required. Stock splits, stock dividend, they are assumed to be outstanding from the earliest reported period. So add up the denominator, which I believe will give you 2.4 million, and net off the numerator, 3350 less 430 gives you 2.92 million. And divided with 2.4 million gives you 1.2166, which is approximately 1.22. So it says LB's basic EPS is 1.12. Wrong. It's 1.22. Right? That makes A to be an incorrect option. Now this is an interesting part. LB's diluted EPS is equal to or less than its basic EPS. We have calculated basic EPS. Let us write it down. Basic earning per share, we've just calculated it is to be 1.22 prox. Now, we just cannot overlook warrants that give the holder the right to convert them into common stock. Now, there could be three situations. First, if the exercise price of your warrants, if it is less than the weighted average market price, in this case, this is the scenario one. If your exercise price of warrants is less than the weighted average market price, then the diluted earning per share would be less than the basic earning per share. Of course, it makes sense. Situation 2. If the exercise price of the warrants, if it is equal to weighted average market price, in this case, your diluted earning per share would be equal to your basic earning per share. And in case 3, if the exercise price of the warrant is greater than the weighted average market price, in that case, the effect of this conversion would be anti-dilutive. In that case, diluted earning per share, at least in computation, would be greater than the basic earning per share, which is not required to be reported. So that's the only possibility. Diluted EPS would either be equal or less than the basic earning per share, not more. If it is, then we don't report that. We just give EPS as our diluted earning per share. So that makes B to be the correct option. Next, Cell Services Incorporated, CSI, had 1 million average shares outstanding during all of 2009. During 2009, CSI also had 10,000 options outstanding with an exercise price of 10. That's EP in our formula, $10. The average stock price of CSI, that's average market price, during 2009 was $15. For the purpose of computing diluted earning per share, how many shares would be used in the denominator? I gave you in a formula, average market price minus exercise price upon average market price multiplied by the number of shares that can be obtained by exercising the options. So just plug in the numbers. That is, I believe it's 15 minus 10 upon 15 times 10,000, and it would result in 5 by 15, that's 1/3. 1/3 of 10,000 is 3333. So this is the addition to the denominator. Since 1 million shares are already there, 1 million plus 3,333 will give you 1,003,333, A to be the correct option. When calculating diluted EPS, Which of the following securities in the capital structure increases the weighted average number of common shares outstanding without affecting net income available to the common shareholders? Now, this is the formula. Now, look at this. When you make an adjustment for convertible preferred stock, you need to add back preferred stock dividend. So, an adjustment is needed in the numerator as well as in the denominator. When you have bonds, convertible bonds, in that case, you need to adjust your denominator as well as you need to add back after tax interest. So, convertible bonds, convertible preferred stock, they will require an adjustment in the numerator as well as denominator. But if you have options, then options will result in an addition to the denominator only. So now we know, when calculating diluted EPS, which of the following securities in the capital structure increases the weighted average number of common shares outstanding without affecting the net income available to common shareholders? So since there is no adjustment for this, so that makes A to be our correct option. And A it is. Make sure you read the details given. That will give you much finer understanding why the correct option is correct and why the incorrect is incorrect. All right, here we go. Selected year and financial statement data for work hard are shown below. We have beginning shareholders equity. We have ending shareholders equity, unrealized gain on available for sale securities, unrealized loss on derivative accounted for as hedges, foreign currency translation gains on consolidation, all these are OCI items, and dividends paid, and the net income. What are we required to calculate? Work hard's comprehensive income for the year is, remember, comprehensive income is the sum of your net income plus other comprehensive income. What is other comprehensive income? Other comprehensive income contains certain income items. Remember, OCI contains income items. And these income items are excluded from the computation of your net income. What are those transactions? These given in detail. So, the first one is the effective portion of cash flow hedge. Second, gain on remeasurement of available for sale debt securities. Debt. Gains on foreign currency translation in case a foreign subsidiary is being consolidated. So any translation gain and loss goes to other comprehensive income. And loss on the defined benefit post-retirement plan. So combination of OCI and net income, it gives you what you call the statement of comprehensive income. Right? So what are we required to do? Our comprehensive income for the year, we need to first plug in the numbers. Net income is given as 15. Other comprehensive income. We are given three components of other comprehensive income. Unrealized gain on available for sale securities, debt securities, debt, I'm repeating, debt securities available for sale, their gain and loss goes to other comprehensive income. Unrealized loss on derivative accounted for as hedges, effective portion of losses on the cash flow hedge, it's a deduction, and foreign currency translation gain to be added. So these three will give you the sum of OCI. So let's just add these up. It's 5 minus 3 plus 2 gives you 4. So net income is 15 and other comprehensive income gives you total 4. This total 4 goes to your accumulated other comprehensive income in the statement of change in equity. So 15 plus 4, that should be the comprehensive income, should give you 19. So work hard's comprehensive income for the year is 18. No, it's 19 million. Incorrect. B, it is increased by the derivatives accounted for as hedges. It is not increased. There is a loss. Unrealized loss on the derivative accounted for as hedges. So decrease would have made it correct. Decreased by the derivative accounted for as hedges. Wrong. Then C, it includes 4 million in other comprehensive income. Perfect. C. Look no further. There is no further. So that makes C to be the correct option. 17. When preparing an income statement, which of the following items would most likely be classified as other comprehensive income? We have just seen these. These are the 4 principal items you would see in other comprehensive income. So let us see which of these is given. So when preparing an income statement, which of the following items would most likely be classified as other comprehensive income? A foreign currency translation adjustment. Absolutely yes. An unrealized gain or loss on a security designated as a trading security, whether it's a debt or an equity security. If it's a trading security, any unrealized gain and loss goes to your income statement, not to OCI. A realized, mind the word, realized gain, any gain that is realized gain or realized losses, by default it goes to income statement. So realized gain on a derivative contract not accounted for as a hedge goes to income statement. So B and C goes to income statement, A goes to other comprehensive income, hence A is your right answer. Moving on. Okay, apparently an innocent question. A company A owns 60% of company B. A holds 60% control in company B. Let us discuss something more at this point in time. If you hold, let's say if A holds between 0 to 20% of securities of B, accounting is different. If A holds between 20 to 50%, then the investment is accounted for totally differently. And when the holding is between 50 to 100%, then we go for what you call consolidation. So if the investment is between 0 to 20%, it could either be reported under the fair value option, or we can account it for under as a trading security. But if the holding is between 20 to 50%, then we have two options. Either we report it under the fair value option, or we report it using the equity method. But if the holding is between 50 to 100%, in that case, you combine your results with B. A and B are viewed as if they are a single economic entity. Income statement is added to the income statement, balance sheet is added to the balance sheet, right? So this is what will happen. A company A owns 60% of the company B. Company A's consolidated income statement most likely include 100% of company A's revenue and expenses and 100% of company B's expenses and revenue. It's all added together as if they are a single economic entity. So that makes B to be the correct option. Next. The following data is available on two companies that operate in the same industry. We have been given sales, cost of goods sold, administrative costs, interest expense, research and development expense as well. Which of the following statements is most appropriate? Better margin performance will be reported by, when it says margin, so we need to see which margin, gross margin and operating margin. Now this is important. Since only gross margin and operating margins are discussed, so if we draw up a common size income statement for X and Y, we need to ignore interest expense, because interest is after the operating income has been calculated. So we need to exclude this from our computations in order to calculate your operating margin. Gross margin can be calculated by sales versus cost of goods sold, but for operating margins you need to take administrative cost, R&D, interest expense needs to be ignored. All right, let us convert this into common size. Let's taking this as 100 base and expressing 5.7 as a percentage of 11.2. If you do, 5.7 is 51% of sales. and 7.7 is about 53% of sales. Okay. Now, if 100 is sales, 51 is CGS, then your gross margin would be 100 less 51, 49%. 100 less 53, 47%. So, with regard to gross margin, X is faring well. X has a better gross margin. Now, let us calculate the operating margin. For this, we need to convert these numbers into percentages as well. Administrative cost is 1.9. 1.9 is what percent of 11.2? It's about 16.9 rounded off to 17%. And 1.5, which is R&D, it is what percent of 11.2? That is 13.39. We can write it as 13%. So 49 less 17 less 13 gives you 19%. Okay. Then 2.2 is what percentage of sales? 15.17. We can just write it simply as 15. 1.7 is what percentage of sales? 11.7, which can be written as 12%. So 47 less 15 less 12 gives you 20%. So these numbers are your operating margins. So as you can see, for company Y, operating margin is 1% higher than company X. So what we can conclude, company Y is better in gross margin? No. Company Y is better both in gross and operating margin? Wrong. Company X has a better gross margin? Correct. And company Y has a better operating margin on comparative basis. So without doubt, C. Next. The following data are available on a company. What are we required to do? Under a common size analysis, the value used for research and development expenses expressed as a percentage of sale is a very straightforward question at this level. It's what percentage of total revenue? 12 upon 282 times 100. It's about 4.255%, which is given here as A. Next. A company sells a product with a 3-year warranty included in the price. According to IFRS, which of the following is the most appropriate accounting treatment for the warranty? A. Fully recognizing the revenue at the time of sale. That is right. But waiting until actual warranty costs are incurred to recognize the expense. This is wrong. You are recognizing revenue in full, but relevant expenses being deferred into the future for what? That is not acceptable. You can't wait until actual warranty expenses are incurred. In order to make matching concept work, you have to recognize entire, mind the word, entire estimated warranty expense in the same year in which you recognize the revenue. This is wrong. So what is the appropriate treatment of warranty? Fully recognizing the revenue right now and estimated warranty expense right now at the time of the sale, and updating the expense as indicated by later when the warranty expenses in cash, refunds, repairs, or any relevant labor is incurred in case of warranty claims. So that makes perfect sense. That makes perfect sense. What about C? Deferring all of the revenue and recognizing it over the life of the warranty period? Wrong. That is done in case of US GAAP if the warranty is a service type warranty. Well, that is not something I'm going to delve in detail. This is we do in CMA and CPA, not in CFA. Let me not put you in trouble. Next. The following table shows changes to the number of common shares outstanding for a company during 2012. 1st January, 180 shares outstanding. Okay. June, 60,000 shares issued. Okay. 1st August, there is a 2-for-1 split. Now, this is a very important question, specifically selected to teach you something special. whenever you see a stock split or a reverse stock split, I'm sure you know the difference. 2 for 1 is stock split, 1 for 2 is the reverse stock split. Whenever there is a split, the recommended approach to calculate earning per share or diluted earning per share is to follow transaction to transaction. Normally what we do, let's say if there is no such stock split, what we do, we simply give 180 the weight of full 12 months and the weight to these 60,000 shares of June to December. So it's going to be 7 months out of 12, right? That's what we normally do. That's what we did in the previous question. But when there's a stock split, this approach won't work. It will mess things up. The recommended approach in this case is to go transaction by transaction. When I say transaction, I mean stock transaction by stock transaction. So the first transaction occurred on 1st June, which means from 1st Jan to the end of May, 5 months, there was no stock transaction. So these 180,000 shares remained outstanding for 5 months out of 12, thereby giving it a number $75,000, 75,000 number of shares. All right. Then we issued 60,000 new shares, which took the number of shares from 180 to 60, added 240. Now these 240 shares remain outstanding till the next stock transaction. Full June, July, and at the start of August there was transaction. So we're going to multiply it with 2 divided with 12, and if we do, it's going to be 240 times 2 upon 12, and that would be 40. Now, what's the number? 215. What happens in August? 2 for 1 stock split. Each stock is split into 2. So if there were 215 shares, in 1st of August, they will be now doubled. It's going to be 430. Now, these are the actual shares. These are the weighted average shares where we consider the time lag as well between the stock transactions. So this is what you will use in the denominator. So to calculate earning per share for 2012, the company's weighted average number of shares outstanding is closest to 430. So remember, whenever there's a split or reverse split, go stock transaction by stock transaction. That is the easiest way. Otherwise, you will mess things up and end up with nothing. Next. The following data are available on a company for the current year. We have been given comprehensive income, dividends paid, earning retained at the end, and earnings retained at the start. In other words, opening retained earnings, closing retained earnings. What are we required to do? The company will most likely report other comprehensive income in pounds, in thousands, as we just learned a little while ago. Comprehensive income is the net of net income plus other comprehensive income. We are required to find out OCI. We have been given the comprehensive income 246, but we do not have net income. Can we calculate this? Yes, we can. We have been given the dividend payments, retained earning closing balance, and opening retained earning balance. So it's a fairly straightforward computation. Opening balance of your retained earnings. To this we add our net income. That gives you the total profit available for distribution. Out of this, this is what we distribute, and after this, what we get is the closing balance of retained earning. It's basically the statement of changes in retained earnings. Opening balance of retained earning, net income, less appropriations is equal to the closing balance of your unappropriated profit. Plug in the numbers and you will find the unknown net income. Opening balance of your retained earning is 580. Net income is to be calculated. Dividends paid or declared, both are deducted, 60 is equal to closing balance of your retained earning, that's 821. Okay, so making net income as your subject of this arrangement, 821 less 580 plus 60 should give you what? Let me add this up. 821 minus 580 plus 60 gives you 301. So net income is 301 now. It's a fairly simple arithmetic. 301 is equal to 246. We just need to calculate other comprehensive income. So other comprehensive income is equal to 246 less 301, which indicates that it's going to be a negative number, negative 55. So it's not other comprehensive, it's basically a loss, 55. A. You can do in many ways, whichever you feel convenient. You can draw up a T account, plug in the opening, closing, and then you can find the unknown numbers. Now, this is again an EPS or diluted earning per share question. Look for, is there any split? Split. There is no split. Just stock transactions, repurchase, some stocks issued, but there is no split involved. That makes things very easy for you now. The following relates to a company's common equity over the course of the year. Outstanding shares at the start were 2 million. Stock options outstanding at start and end of the year were 100,000. This is the exercise price. Shares issued on 1st of April. Shares repurchased, treasury stock on 1st of July, and the average market price is given. So what are we required to do? If the net income is 5 million, you need to calculate the diluted earning per share. But for that, we need to calculate. We have net income, we have the numerator, but we do not have the denominator for our diluted earning per share computation. We need to find the denominator. That's the weighted average number of shares. Now things are pretty straightforward. No split is involved. So these 2 million shares were outstanding throughout the year. Multiply with 12, divide by 12. So they will carry full weight of the whole year, 2 million. Okay, then shares issued on 1st of April. April, May, June, July, August, September, October, November, December. 9 months. So they remain outstanding for 9 months out of 12. Thereby, 300 times 9 upon 12 gives you 225. So I'm just going to write it in millions, 0.225 million. So I have limited space here. Shares repurchased. You repurchased 100,000 shares on 1st of July. From July to December, 6 months. So it means multiply this with 6 upon 12, which means 50,000. Since it's repurchased, treasury stocks, it's a deduction. It's 0.05 million, 50,000 shares. 0.05 million. And there's no other stock transaction. So just add these all up to plus 0.225 less 0.05 gives you 2.175 million. Or let's write the full amount, 2,175,000 shares. Okay, now we need to make adjustment for stock options, and we know the formula. What was it? The average market price, which was given here, 20, minus exercise price, which is 5, upon average market price, 20, multiplied by the number of options that give you the right to purchase shares, and the number of options are 100,000. So it's going to be 20 minus 5 upon 20 times 100,000 means 75,000. So this 75,000 would be added to 2175. So it's going to give you 2.25. So this is going to serve as your denominator in your diluted earning per share computations, and simply get your result. So 5 million divided by the answer, it gives you 2.2222, and it goes on till infinity. B is the right option. B it is. Next. The following table summarizes income statement data for a manufacturing company. Okay. Compared with 2020, the 2021 common size income statement most likely indicate what? Lower tax rate. Okay, let us just see what was the tax rate last year. Tax rate is income tax upon pre-tax income. So 120 upon 460. 120 upon 460 gives you 26.08. So I'm going to write it as 26.1%. What is the average tax rate now? 155 upon 580 times 100 is 26.72. So lower tax rates, wrong. Tax rate has gone up marginally. This is wrong. A is incorrect. What about B? Cost cutting in selling and general administrative expenses. Had there been cutting, so we would see a reduction in the percentage. So 260 is what percentage of the sales last year? It's about 11.18%. 11.18%. And what is your selling and general administrative expenses as a percentage of sales now? 295 divided by 2611 times 100 is 11.298, approximately 11.30. Wrong. There is no cost cutting. Rather, your selling and general and administrative expenses have marginally risen as a percentage of sales. This is an incorrect option. So you can just click C and go home. Sale on new differentiated product most likely indicates sale of a new differentiated product. Well, for this, where do we need to look at? It could just be a combination of sales and cost of sales. Nothing else would give any idea. Sale of new differentiated product will involve two things: the relevant revenue when you sell that particular product, differentiated one, and the cost. And where do we see these? Right here, net revenue and CGS. So why don't we just calculate the net of these two, which in fact is your gross profit. So let us see what is the gross profit as a percentage of sale in these 2 years. So 775 upon 2325 gives me 33.33% last year. What is the percentage now? 930 upon 2611 times 100 gives me 35.62. Well, that shows some improvement here. Your gross margin has gone up, and this could be the justification. A new differentiated product that may have a higher selling price or a lower cost or both, and this has resulted in a higher gross margin than the last year. So that makes C to be the correct option. Next. A company incurred the following unrealized holding gains in the current year. Unrealized holding gains. $100,000 unrealized holding gain on securities held for trading. Trading securities. Any gain or loss, whether realized or unrealized, on trading securities, it goes to the income statement. $500,000 on the foreign currency translation adjustment of a self-sustaining non-domestic subsidiary. Non-domestic means it's in some other country, and self-sustaining means it has its own self-sustained cash inflows and outflows. So when you translate such subsidiaries' financial statements, add them up in your financial statement, this would result in a foreign currency translation gain or loss, and this is one of the items that is reported in other comprehensive income. Gains or losses on the foreign currency translation adjustment. So that makes C to be the correct option. Next. Under the US GAAP, which of the following would most likely be reported as an operating item on a manufacturing company's income statement? Manufacturing company. Keep that in mind. Means it's a non-financial services firm. All right. A gain on the sale of non-strategic investment. A non-strategic investment, a gain or loss on it's a non-operating income. We're looking for something that would be reported within the operating section of your income statement. So non-strategic investment is not reported as a part of your income statement. Interest expense on long-term debt. Servicing of debt, borrowing cost. For a manufacturing company, it is reported as an interest expense and it is shown after your operating income. So this is incorrect as well. Then an impairment loss on obsolete inventory. In payment loss, under the US GAAP, it is, and even under the IFRS, it's a regular occurrence for a manufacturing firm. So it's an operating item. So what's the difference? Had it been IFRS, what would have been the difference relating to the impairment loss of inventory? Remember, under the US GAAP, any impairment loss on long-lived assets, any impairment loss on intangibles, any impairment loss on inventory, once written off, cannot be reversed. But it's a part of operating income. And in case of IFRS, such a loss again is a part of your operating income, but you can subsequently reverse the loss, but the reversal should not be more than the write-off. Well, that's an added knowledge. So we know that makes B to be the correct option. Moving on. For which of the examples given would common size income statement generally provide the greatest insight? Which of these examples given would common size income statement will give you the greatest insight, greatest meaningfulness? Okay, let's see. A liquidity analysis of two companies within the same industry using income statement. How can we use income statement to assess the liquidity of two companies? Income statement shows the result of your operations, not liquidity. For that, you need to compare the balance sheet items in percentage terms. So this is incorrect. A is incorrect. What about C? A comparison of similarly sized companies from different industries. Now this is interesting. If the firms are of similar size, there is no point in drawing up of common size statements, because common size financial statements are primarily intended to compare two businesses that are of dissimilar size. So this totally negates the very purpose for which we draw up the common size financial statements. Then what? B. Why? A time series analysis of a rapidly expanding single company. Well, you may take 2007 as your base year and you can express all of the subsequent income statements, 2008 so on to 2021. All sales figures and expenses can be expressed as a percentage of base year numbers. This is called horizontal common size analysis. That would make more sense for income statement. Perfect. B is the correct option. Okay, then. Common size income statements are shown for three companies in the same industry. Same industry. That's an important point to be noted. Which company is most likely to have a technically superior product? Now this is interesting. First information that was relevant is that they are from the same industry. They are operating in the similar markets, offering similar products more or less. We just want to see which of these firm is technically more superior with regard to products. Where can we see that? Well, if they are products, so do we need to just see cost and revenues? That is cost of goods sold and the revenue. That's where we need to look at. Because if a firm is technically superior, it will have a better gross margins. Let's see which firm has. 100 less 65, so this firm has a margin of 35%, 50%, and this one has 70%. Now, one part of the question is answered. The firms are in the same industry and Z appears to have a better margin than the others, but still it doesn't answer the remaining part. If this is the effect, higher profitability, what is the cause? I need to know the cause. Administrative expenses are all the same, so we don't see the difference in these. Advertising, more or less, then this firm should have a higher percentage of gross margin than the others. Then the justification why Z has a higher margin, has technically superior product, because firm Z is spending more on research and development. That's the cause. This is the effect. Cause and effect will tell you which firm has technically superior product, gross margins, and the spending on R&D will tell you. So that gives you A as your correct option. A it is. Next. Which of the following expense recognition choices is least consistent? Mind the word least consistent with conservative accounting of reported net income. Okay, moving in the reverse order so as to convince ourselves that we got the right option and the right is right. Estimating lower uncollectible accounts, lower provision for your bad debts due to stricter credit policies. Perfectly valid. It's perfectly fine. There is no aggressiveness or conservatism here. If you have stricter credit policies, you will have lower uncollectibles. So this has nothing to do with conservatism or aggressiveness. Totally inappropriate in the given situation. B. Reflecting lower warranty expenses due to improved product quality. Perfectly fine. If you have improved product quality, then you are sure that there will be less refunds, less repairs required, less unhappy customers. So improved quality will mean that your estimated warranty expense will be lower. So it has nothing to do being conservative or being aggressive with regard to your income statement items. Then look at A. Recognizing expenses later than earlier. Recognizing expenses later, delaying expenses. This is aggressive approach, and this approach is totally opposite to the conservative accounting. That makes A to be the correct option. Least consistent, A. Totally opposite to conservative accounting. That makes A to be the correct option. Next, which of the following best describes a component of income statement? Amounts that a company owes to its vendors for the purchase of goods and services. Straightforward. Elementary accounting question. Current liability. The amounts that you owe to your vendors for the purchase of goods and services is a current liability. Outflows or depletion of assets. Assets consumption called depreciation, amortization. Outflows for spendings, expenses. Outflows or depletion of assets in the course of business activities. This is what is referring to expenses, and this is something that we report in income statement. Expenses and revenues. What about C? Obligations from past events that are expected to result in an outflow of economic benefit. This is the definition of your liability. Liabilities are obligations from the past events that are expected to result in an outflow of economic benefit. So A and C refers to liabilities, B refers to expenses. And this is what is the part of income statement. B is the right answer. Next, at year end, a company has non-convertible debt, ordinary shares, and employee stock options outstanding. The company's capital structure is considered to be, we can't say it's simple. It is complex. It is complex. Employee stock options outstanding. So it's complex because the company has both debt and equity. But having debt and equity doesn't mean that maybe debt is non-convertible, fine. But what about the options? This makes capital structure complex, not having debt or equity. Debt and equity itself do not make the capital structure complex. Then complex because the options are convertible into ordinary shares. That's the right answer. Look no further. It's B. What about C? Simple if the options are anti-dilutive. If options exist, whether they are dilutive or anti-dilutive, it doesn't matter. It will still be considered as complex. So that makes B to be the correct option. Next, for a company paying preferred dividend, the components needed to compute basic earning per share are, if a company pays preferred stock dividend, how do we calculate EPS? Just you need to write down the formula and you will see the correct option will automatically fall into the right place. EPS is equal to net income minus preferred stock dividend divided by the weighted average number of shares. So the component needed to compute basic earning per shares are net income, yes. Weighted average number of common shares outstanding, yes. But this is not all. We need preferred stock dividend as well. Preferred dividend, yes. Weighted average number of shares outstanding, yes. And you got all what you need to calculate your EPS, and that makes B to be the correct option. Next, selected year-end financial data for Smelly Enterprises follows. Net income is given, tax rate is given, weighted average number of common shares outstanding is given, and 12% bonds convertible into 3,000 common shares, and they are potentially dilutive. So we need to calculate the diluted earning per share. Potentially dilutive, but are they or are they not? Let us first calculate earning per share, which is quite a fairly straightforward computation. So what we have is net income, which is $200,000, and the weighted average number of shares is 125. So 200,000 upon 125 will give you 1.6. We need to calculate the diluted earning per share. All right. Let us calculate diluted earning per share. Diluted earning per share will involve net income divided by the weighted average number of shares. Since we have convertible bonds, which means that these bonds will be converted into 3,000 common stocks in the future, but whenever we will have to deduct, or rather add, the interest after tax interest, because when the bonds are converted to shares, interest saving, after tax interest saving needs to be adjusted in the numerator. So if this is the amount of the bonds paying 12% interest, 60,000 times 12%, which is 7,200, and we need to multiply it with 1 minus 15%, which is the tax rate here. So it's going to be 7,200 times 0.85. To this we add 6120 plus 200,000 divided by 128,000. So this is interesting. Your diluted earning per share is 1.6103. Now listen to me very carefully. Your diluted earning per share has to be less than or equal to EPS. Diluted earning per share, if it's greater than EPS, which is in our case, your diluted earning per share is more than your EPS, you report your EPS as your diluted earning per share. So in other words, your diluted earning per share and your earning per share, they would both be the same, and it's going to be 1.60. That makes B to be the correct option. Next, a firm with convertible securities initially calculated that its diluted EPS is greater than its basic EPS. That's what we've just done. A firm with convertible securities initially calculated that its diluted EPS is greater than its basic EPS. What the firm should do? What we've just done. Report your basic EPS that is equal to the reported diluted EPS. Khalas. Next, when preparing a common size income statement, the appropriate denominator for converting the reported cost of sales. All the elements of your income statement are expressed as a percentage of your revenue. Now, this is one important point. Let's say you have been given your sales as $120,000 and your sales returns as, let's say, $5,000. So in that case, you do not take sales as a basis. You take net sales, $115,000, as your base. That will you will use as a base to calculate your percentages. So I would say the appropriate denominator for converting the reported items of your income statement is the net revenue adjusted for returns and allowances for returns. So that makes A to be the correct option. Okay, next, using common size income statement to compare a company to its peers, an analyst can determine companies' relative performance. When we compare two businesses of dissimilar size using common size financial statement, An analyst can determine company's relative performance with its competitor. If you want to see the size, then there is no point in converting your common size financial statements into common size. There is no need to convert your financial statement into common size financial statements when you just want to measure the size. This is totally irrelevant. And what about revenue recognition policies? For this, we don't draw up common size financial statements. Just look in the notes, because revenue recognition policies, your estimates, are found in the notes to accounts, not in the common size financial statements. So that makes A to be the correct option. Okay, now what about this firm? We have been given three companies ABC, and what are we required to do? The company with the greatest or the highest gross profit margins, a very straightforward question. The gross margin here in absolute dollars is $19,000, $90,000, and here it's 450 less 240, I believe it's 210. Let us express these gross profits as percentage of revenue. So the first one is 19 by 40. It's 47.5%. Then we have 90 by 200,000. It's 45%. Then we have 210 as a percentage of 450. It's 46.66%, which is basically 46.7%. So the firm with the highest gross margin is A, without doubt. So fairly straightforward question. A is your right answer. Next, under the US GAAP, a company's comprehensive income, which we know is the sum of your net income plus other comprehensive income. So under the US GAAP, a company's comprehensive income is reported as net income less common stock dividend. No, common stocks are not deducted from net income. Rather, it's part of your equity adjustments in your retained earnings. The change in equity during a period from transactions and other events and circumstances from non-owner sources. Non-owner sources means additional shares issued or dividends distribution. These are the transactions with the owners. Then what he's talking about, comprehensive income is equal to net income plus minus other comprehensive income. So basically your comprehensive income is the change in equity that is because of transactions during the period or some other events, those four events we discussed earlier. This is what results in, gives you a comprehensive income which goes to your equity, and it excludes transactions with the owners. Transactions with the owners, the transactions with the shareholders is new share issues, stocks repurchases called treasury stock, any dividends, stock dividends, maybe property dividends, so on and so forth. So that makes B to be the correct option. Okay. An analyst notes that the company's most recent financial statement shows 65 million pounds in the net income. This is your net income. 7 million in dividends paid to common shareholders. Okay. And 5 million of other net expenses items excluded from net income. Interesting. If 5 million are other net expenses and they are not in net income computations, then where the hell are they? Then they must be in other comprehensive income. Right? If they are not expenses but not in the income statement, where could they be? OC. And what those four items which we discussed earlier, I'm sure you remember, gain and loss for available for sale debt securities, effective portion, gain and loss on available for effective portion of cash flow hedge, foreign currency translation involving foreign subsidiaries, and the defined benefit post-retirement plan, any gain and loss related to this. So clearly these are the items of expenses or gains not reported in the net income called OCI. So we know comprehensive income is the sum of net income plus or minus OCI. Right? So what are we required to do? The company's comprehensive income is, net income is there, 65. From this 5 million is net expense. You give 60 as your comprehensive income. 7 million dividends paid to your shareholders. These are the transactions with the owners. Right? So owner related transactions, they are a part of your retained earnings, or they are part of your treasury stock, or as a part of your shares repurchased or share issued to the shareholders. So they are not part of your comprehensive income. So they can't be shown here. So it's going to be 60. That makes A to be the correct option. Next is an interesting one. Selected financial data follows for companies A, B, C. We have been given price per share, net income for each, other comprehensive income or loss in case of A, common stock, dividends paid, shares outstanding. What are we required to calculate? Which company has the lowest price earning ratios calculated using the comprehensive income? Rather than using net income as a way to calculate your EPS, we need to calculate price earning ratios using comprehensive income. For that, we need to first calculate comprehensive income. And what is comprehensive income? It's sum of your net income plus other comprehensive income, which means we just need to combine these. 150 less 17 is 133. 500 plus 65 is 565. That's your total comprehensive income, and this is 850. What are we looking for? Price earning ratio. What is price earning ratio? Market price per share over earning per share, but earning per share in our case is going to be the comprehensive income per share. Comprehensive income per share, 133 upon 100 gives you 1.33. 565, which is your comprehensive income upon number of shares, gives you, let me calculate this, 565 upon 125 gives you 4.52. And then 850 upon 300, that's 2.83. Right? So these are the comprehensive income per share. We need to calculate price earning multiple, taking the market price of each 27, 88 and 53 and dividing this with comprehensive income per share, which is 1.33 in case of A, 4.52 in case of B, and 2.83 in case of C. So it's going to be 27 upon 1.33 is 20.3, 88 upon 4.52 it's 19.47, and 53 upon 2.83 it's 18.73. So which firm has the lowest price earning ratio? The lowest one is C, and C is in B. That makes B to be the correct option. Right? Okay, which of the following items is treated as other comprehensive income under both IFRS and the US GAAP? Okay. Cost of companies' defined benefit post-retirement plans that are recognized in the current period. Now, this is interesting. Recognized in the current period. Costs. These costs have already been recognized in the current period's income. They do not appear in other comprehensive income, neither in IFRS nor in the US GAAP. They are not a part of other comprehensive income. What about B? Foreign currency translation adjustments from consolidating financials of foreign subsidiaries. That's one of the elements of OCI, foreign currency translation of foreign subsidiaries. It is reported as a part of other comprehensive income, both in IFRS and the US GAAP. True, correct answer. But why not C? Let us discuss this. Certain changes in the value of long-lived assets measured using the cost model. Gentlemen, I hope you know, even you may not be accounting specialists. US GAAP follows cost model for long-lived assets, which means there is no revaluation surplus that could be reported in the equity. But under IFRS, we have two options: use cost model or the revaluation model. So in this case, the gain on revaluation goes to OCI in case of IFRS. So here they differ, but here they are on the same page. That makes B to be the correct option for sure.